We have some major developments in the commercial real estate space, including a bizarre Blockbuster $500 million foreclosure in New York. The Real Deal is calling this the largest debt auction yet. We have delinquencies skyrocketing, but somehow they're spinning this to say that the growth of delinquencies is slowing. We have AAA bonds that have lost 25% of their value. AAA, guys, that's the highest you can have. And I'm going to show you in Nashville a building that's 100% leased right now. It's an office, Class A, beautiful building. It's going to be empty in a few short months. And the REIT that owns it, now I'm not going to say they're in trouble, but their Nashville holdings don't look good. It's getting wild. As the New York Times posted a report today that office building losses are starting to really pile up and more pain is ahead. But look at this Real Deal story here. Billionaire developer and film producer Charles Cohen could see the credits roll with largest debt auction yet. Look at this. Blockbuster foreclosure could be the fallout the industry has been waiting for. Apparently, Fortress, the lender, sued Cohen for payment on default on one of his properties, or the situation here. It says it filed what sources say is the largest UCC foreclosure filing ever. Meaning, I think a lot of these properties were actually second liens behind a primary debt, where if they did get foreclosed, the primary loan is going to get taken care of before they get anything. So you can see if you're second lien and you're filing a foreclosure, that's very interesting. Now, Charles Cohen and his group, they have $1.1 billion of distressed debt right now. And a lot of it's fixed rate. However, just like this, you can see he's apparently very over-leveraged, borrowing more and offering collateral on properties that really aren't even making any money. It says Fortress asked for property financials, but Cohen's team dragged their feet. Why? Because one of them was losing $2.7 million and the other one was losing $4.3 million. And I don't know if those have got to be annualized returns, but it says in June it lost 2.7. I don't know what's happening there, but it's going to the auction block on July 1st. Pretty wild that this is happening. $500 million. You know, some of these offices, I looked at them, they're just offices. They're 30% vacant, some of them even worse. And they're just non-performing. This is so funny. Commercial real estate loan delinquency growth decelerated again. I mean, this is silly. Okay, so commercial real estate loan delinquency growth decelerates again. It's saying it's growing just at a slower rate. Now, why might it be growing less? Well, one of the reasons, and this is kind of funny, but I don't know if y'all saw this headline, losses pile up in top-rated bond backed by commercial real estate. We are starting to see losses pile up. This AAA bond that got just absolutely, it was commercial mortgage-backed security. Every single bondholder got wiped out. And the AAA bond was the only one that didn't get completely wiped out, but it only lost 26%, a $40 million loss. So let's go back to this headline. Commercial real estate loan delinquency growth decelerates again. The delinquency is slowing in its growth rate. This is such a silly headline. One of the reasons it's slowing is because some of the commercial mortgage-backed securities are getting settled and the bonds are getting written off. Honestly, it's no longer factored into delinquency once it's foreclosed and settled. By the way, AAA bond here, just so you know, the U.S. government debt isn't rated AAA. S&P downgraded the USA in 2011. I would laugh, and honestly, I think it is funny, but it's in our retirement accounts, okay? This is actually in our retirement accounts, and this is why I'm so worked up. These buildings are going to be empty. The one I'm going to show you here in a minute, these things get hit and then they hit our retirement accounts. Don't believe me? Let's take a look at this story here. Commercial property meltdown clobbers pension funds. So we have two kinds of retirement accounts that are getting hit. We have bond funds and we have pension funds. Okay. Your 401ks. I have a bond in my 401k right now. It's lost 55% of its value in that bond. Okay. It's tied to a mall in San Francisco, but it's a bond fund, right? It's not the only one in there, but that bond, that one's toast. Now, the bond fund hasn't even written it off yet. Okay. So they don't use fair market value. They use hold to maturity. So it's showing up when I log in. It's like, oh, no losses here. Okay. That's how it's working in my 401k. Now, on the pension side of things, it's a real disaster because a lot of these were cash purchases. So they're taking 100% dollar for dollar asset write-downs. And the good news is they're not forced to sell. Okay. But in the case of some of the largest pension funds in the world, they are taking massive losses, like the Canadian pension fund. Look at this. Canadian's National Pension Fund said in May it is selling stakes in Manhattan and San Francisco office towers for a $225 million less than it paid. $225 million loss. This is in May, but somehow the bottom is in. I'm not seeing it yet. It's all hope. I mean, they're praying for interest rates to just nosedive, and who knows? I don't see it though. I don't see it. Now, this is also at the same time in March, consultants warned California's teacher pension that office holdings would continue to drag down returns even after it already lost 9%. What's wild about this is CalSTRS owns $50 billion, $48 billion in property holdings. Office makes up about 18%. Do you actually think that office is $10 billion? Do you actually think they have $10 billion of office? And before you go the conspiracy route, like, how do you even value office? It's not trading. It's got no income. Like, what do you use? Cost to build? And I did, by the way, I did a video on empty office buildings. I walked through an empty office in Cool Springs, Tennessee. Cool Springs, Tennessee, In-N-Out Burger headquarters just moved to Cool Springs. I mean, there are a lot of businesses moving to Middle Tennessee, but these offices are empty. They're empty, and there's just way too much office for the demand for it right now. And so the video I did, I'll put a little pin, I'll link it up somewhere where you can click on it. But if you want to see that video, that was owned by the Florida pension system. And while it's empty, I mean, they said it was 70% leased, but y'all, there's not 70%. The occupancy was almost none. I mean, it was wild. I walked through empty floors. I just walked around and talked for 10 minutes. It was wild. But anyways, so when people are worried about the banks, okay, a lot of people talk about the banks being the ones that are in trouble. I'm not worried about the banks. The banks are going to get bailed out, okay? But the retirement funds, that's going to impact you, okay? And something I think is much less likely to get bailed out. And one of the reasons is it's just going to show up as below average returns. A lot of these are going to get mixed with a lot of other stuff. And so you don't realize that the commercial real estate losses that you're paying for are just eating away at your returns by being in these bond funds or being in the pension funds. And that's part of what the argument is for diversification, okay? So let's take a look at the office disaster here in Nashville. Now, guys, the one I'm going to show you, it is bad, okay? It's Class A. It's 100% leased. It's in a great location. No, I'm not talking about the Moore building, because they just signed a lease with TikTok.
TikTok is suing the U.S. government over a new law that would have forced its Chinese parent company ByteDance to divest the app or face a nationwide ban, marking the first legal challenge since that law actually passed in April.
That's supposed to be funny, but it is what it is, right? But it does kind of show you how popular Nashville is. I mean, Nashville's got plenty of beautiful buildings, great locations. It's just demand has evaporated for office and has moved, office has moved into our residential section. A lot of people need offices at their house because that's where they work. So this building looks great on paper. In fact, here's the Business Journal showing 100% leased. You look at this and you think, there's no way that there's a problem. Let me show you a picture of it here. Look at this. Beautiful building. Beautiful building. It's just going to be empty. It's going to be empty by the end of the year if they don't get a tenant. Now, I personally hope they get a tenant. This is a nice building. The problem is that why are all the tenants moving out? Because Class A, you can spend what you want on office and you're going to be where you want to be. And there's a new shiny building in Nashville, and that's where they all want to move to. So they're all moving into new buildings, signing up long leases, and they're leaving this one really for Highwood to figure out what to do with it. Now, Pinnacle Building, it opened 15 years ago. They were able to lease it up, build it up, make it strong. But now, Pinnacle, 64,000 square feet, soon to be vacated. Bass, Berry, and Sims, let me show you, soon to be 161. Look at these, 1, 2, 3, 4, 5, 6, 7, 8 floors, soon to be vacated. Okay, so we've got they're leaving. We know they are leaving. And I think all of the ones that are split like this are showing that they're leaving, but I don't know that for sure. I mean, it was sold in 2013. Highwoods Property, which is a REIT based in Raleigh, North Carolina, actually owns this. They bought it for $150 million. And now it's going to be empty. That's not good. And Highwoods owns a lot of the office disaster. They own Assurion's building, $266 $266 million headquarters. There's 3 floors in Assurant that's not being used. Completely closed down. I know that. I used to work there. I have friends that work there. They're not using a lot of their building. It's one of the most amazing offices I've ever been in. I loved working. It's an amazing building. But between those two, that's what? 266, 150. I mean, you're looking at $400 million. Highwoods owns $1.5 billion in office real estate in Nashville. And those are prized. Those are Class A. Those are nice. But a lot of it's Class B. A lot of it's not very good at all. And so it's Class B, like 701 Cool Springs Boulevard. It's 60% empty because you have all these Class B offices that are empty. You've got $1.5 billion of real estate in Nashville. And you kind of wonder how it's going to go. Now, their stock, of course, is up 20% in the past 12 months. So clearly, somebody knows something that makes a lot more sense. I mean, Mr. Market apparently knows what's going to happen. But for me, I'm looking at it, I'm scratching my head. I'm going, look, you've got a 100% leased building that's going to be empty in 6 months. You've got another building that's already closed part of their floors, and those are your prized buildings. Then you go south, and you've got all these buildings that are 60%, 40%, 30%. I mean, there's a lot of vacancy there. I just don't know I don't know how you're making it work. So I don't know how they're making it work, but somehow they're making it work. I think there's a hope and an expectation that the Fed will somehow bail out commercial real estate, and maybe they will. I don't know. Commercial real estate, we're in like 3rd or 4th inning of this. It's got so much longer to go, but we are starting to settle things up. We are starting to see bond funds and bonds lose money, and we are starting to see, I would consider this to be like a more, like we're actually starting to see things getting burned off, sold, and auctioned off for these massive, massive losses. People are waking up to reality that interest rates are going to stay higher for longer. At least they can't plan on them being down. And as long as they're not coming down, there's going to be more foreclosures. There's going to be more upside down loans. I mean, it's going to get bad out there. It hasn't even really started. It really started in May, June, July, August, September, October, month by month, the rest of this year, default after default, it's going to happen. It's just going to keep piling up. So get your popcorn, or, it's just going to be bad, guys. And it's not just office, it's multifamily, it's everything, but it's going to be bad. Thanks for watching.